Let's look at the audit of not-for-profit entities, like those entities that do not aim at making a profit. Yeah, and not-for-profit entities include things like hospitals, schools, churches, mosques, orphanages, clubs, local councils, NGO, and very many others. So, audit procedures in international standards of auditing for other entities are used. So, they're the same audit procedures, but for not profit entities, they require additional considerations. So, we are going to look at the matters that are supposed to be considered when planning an audit of not for profit entities. So, we shall start with the scope of the audit. Scope of the audit, or the things that are supposed to be covered. So, first, the auditor is supposed to find out whether a statutory audit is required. A statutory audit is that audit that is required by law. So he's supposed to find out whether statutory audit is required or not. Then secondly, constitutions or regulators may require an auditor to state whether the not-for-profit entity is meeting its objectives. So supposed to find out whether they're meeting their objectives or not. Then the auditor is supposed to look at the recent recommendations of regulators on that entity. Then the auditor is also supposed to look at the acceptability of the accounting policies that are being used or adopted by the entity. Then also look at the changes in the sector in which the not-for-profit entity is operating, in case there is any changes in the sector that they're operating. And then if they are there, the auditor is supposed to find out whether they adopted to the changes or not. Then another one is past experience of the effectiveness of the not-for-profit entity's accounting system. Like, how was their accounting system performing in the past, and how is it performing right now? So that is the scope of the audit for not-for-profit entities. Let's look at the key audit areas when it comes to not-for-profit entities. So we shall first look at the amount of details in the financial statements auditors are required to report on. And these include, first is the statement of financial activities that shows the financial activities of the not-for-profit entity and how much was spent on every activity. Yeah. Then in some cases, a summary of income and then expenditure account. That account is prepared for only not-for-profit entities. It shows their income and then their expenditure, and then whether it's a deficit or it's a surplus. Then another one is the statement of financial position, showing the assets, liabilities, and then the funds of the not-for-profit entity. Then also the statement of cash flows were required, and then the statement of cash flow shows the inflow of cash and then the outflow of cash. Then also the purposes to benefit the community, like how is the entity planning to benefit the community where it is operating. So those are the key audit areas. First is the amount of details on the financial statements, whereby we have the cash flow statement, statement of financial position, summary of income and expenditure. Then we have the statement financial activities. Yeah. Then the purpose to benefit the community. Let's look at the key inherent risk factors when it comes to not-for-profit entities. Like, what are those risks that cannot be avoided or that are within the not-for-profit entities? So first is the complexity and the extent of regulation, especially in the public sector. So the rules and then the regulations, the laws concerning not-for-profit entities are so difficult to understand. So that is a problem because the auditor may also fail to understand the laws and regulations. Then significance of donations and cash receipts sources like fundraising, subscription, and then donation, etc. So the auditor may fail to understand the importance of the donations that were given because sometimes they receive donations that do not have a purpose. Yeah. Then difficulty in recognition of income from legacies. So it is very difficult to separate the money that they're earning and then the money that they are getting just because of the name that they have as maybe an NGO. Then another risk is lack of predictable income or uncertainty of future income. Like those not-for-profit entities are not certain of the money that they're going to get in future, since they just rely mostly on donations and then subscriptions, because people can decide not to donate or people can decide to donate more than expected. So there is unpredictability of their income. Then another risk is restrictions imposed by constitutions or government on the use of funds. Like there are very many restrictions on how they are supposed to use their funds, when and then where. Then the importance of restricted funds. Restricted funds is that money that has been set aside. It's something like retained funds has been set aside. So it's very hard to get to know the importance of that money that has been set aside. Another risk is compatibility of trading activities with entities' objectives. It's very hard to match the trading activities with the entities' objectives. Then the complexity of the tax rules on income and then VAT when it comes to not-for-profit entities. Another risk is the sensitivity of certain key statistics, such as the proportion of resources used in administration. Like, since it's most of the times it's like charity work, so it's very hard to get to know everything that was distributed, how, where, stuff like that. Then there is need to maintain adequate resources for future expenditure while avoiding excessive build up of revenues, but which is hard since it's very hard to ascertain the expenditure, because they can decide maybe to give out more in a particular period and give out less in the next period. Then let's look at the key control risk factors, like the risks that are related to the control or governance, or how the entity is being controlled. So first is time committed by directors or trustees to the entity's affairs. So it's very hard to determine the time committed, because most of those directors actually do less than what they're supposed to do, since it's charity. Yeah, you have no say about what they do and at what time. Then the skills and qualifications of the directors, for example, not for profit, like you do not need skills to give away food. Yes, so the directors may be unskilled. Then the independency of trustees from each other. There is that risk that maybe the people who are in charge of the assets are not independent from each other. Then the division of duties between management and then trustees. There is a risk that there may not be segregation of duties. Then the degree of supervision of the entity's transactions by directors or trustees. There is limited supervision since it's not for profit. They are not aiming at making profit or retaining customers, so supervision is limited.